Zenith Bank released their half-one results, what analysts are calling better than expected results. And with me in the studio to tell us the story behind these numbers is Udom Emmanuel. He's a CFO at UBA. Welcome to the studio, Mr. Emmanuel. Now, looking at your year-on-year growth, we saw PBT up 47%, PAT grew 28%. Good enough that analysts are talking about a slight upgrade in your 2012 profit before tax estimate. Now, what were the main drivers of growth this time around?
During our year-end 2011, we promised the market that we'll look into cost control measures because our up numbers are always good. We have excellent gross earnings, but our bottom line was not so good at the end as expected. So we needed to look at those cost control measures. And also most of the branches that we opened in the past 1 year were not contributing so much during year-end 2011. So within the first half of this year, they've started contributing a whole lot into the bottom line. So we expect that growth to continue within that trend.
Well, a major concern for most analysts is that interest expense, quarter-on-quarter growth, is sort of outpacing interest income, actually by about 3.8%. Now, this, of course, is despite the loan growth that we're seeing in your numbers. Shed some light on what exactly is going on here.
I would like us to look mainly at what's my net interest margin. The net interest margin actually improved quarter on quarter. This quarter we're on 8.7%, up from 7.52%. And if you look at that margin, you could see that it's still well managed. However, the interest expense, as expected, should have grown much higher within that quarter, if not that we strategically try to slow down in mobilizing high cost of funds. Because if you look at treasury bills rate and then set also what the market will want you to pay on deposits, that will tell you that there's no how we would have still kept the interest expense at the pace it was during quarter one. I think that really accounted for that slight growth. However, our net interest margin was much more positive than what we had in quarter one, and the growth was actually excellent during this period.
However, deposits, we saw deposit growth was just around 3%. Now we know that Zenith generally its strategy has been to lend to large corporates, but in terms of deposits, we're not seeing much growth. It was just around 3% this time around. What is your strategy in terms of growing deposits going forward?
I will tie that also to how liquid we are as a bank. Even as at this half-year result, you could see that our liquidity ratio is still about 60% on the group. We've been quite a liquid bank, net placers of funds over the period. So immediately the interest on term deposits moved. It's always been our strategy that we grow other low-cost source of funding. And with that, you need to also look at our deposit mix. Our demand with time and DOM was about 83%. Time deposit was less than 17%. So it's been our deliberate strategy not to actually continue to mobilize high cost of funds and then try to see how much we can get more yield even from the present mix that we have. We don't think it's so attractive to us to grow at that aggressive rate based on how liquid we are today as a bank. Else we'll just be increasing our cost.
Well, in terms of, I mean, we saw your loan growth, it grew about 9% this time around. Now, in terms of lending, how are you dealing with competitive pressure coming from Tier 2 banks? Because we do know that some Tier 2 banks are now soliciting Tier 1 borrowers or Tier 1 corporates. How are you going to deal with this competition going forward? Of course, this is Zenith Bank's competitive space.
You see, Nigerian economy is quite a large economy. Definitely. And you look at the number of banks that we have, you could see that there's still a whole lot to grow the economy. Manufacturers are still coming up to say that, look, banks are not lending to real sector. I believe the pressure is not so much in terms of, looking for who to lend money to. And the economy is growing. It's a developing country. We believe that there will still be a whole lot of room for all the banks to play in the market, and some borrowers in the past that were not high-grade borrowers are also graduating. They are building up capacity to tell you that they are moving from a lower rating to a higher rating where banks can still lend money to and then still recover their money. I believe as the economy is growing, economy is getting stronger, and there will still be more emerging new champions that banks will lend money to. So the growth will continue but not at the very high pace that analysts are expecting.
All right. Now, you did talk a little bit about this earlier on in terms of costs, and I'd like to know, going forward, what are your targets in terms of cost management? And I'd just like to add, I mean, the CBN MPC actually just came out saying the CRR is now going up to about 12%. And of course, this may pose some turbulent times for banks going forward. Of course, some people say out there that large banks like Zenith will weather the storm best. What is your take?
My take on that is, as of today, we believe so much in what the regulators are doing, and we believe so much in Nigerian economy. So our own role is to support whatsoever the regulators are doing, and then what the direction they want to take the economy to. Coming back to Zenith as a bank, I said so earlier that we're quite liquid, and they just increased it just by 4% from 8 to 12%. We believe, well, this will make sure that banks hold so much than well, what they will think they need to run. But I still believe with holding 12% and releasing the rates will still be a whole lot of room for us to lend. And coming back to look at our loan to deposit ratio, we're just at 58%. Mm-hmm. So we believe the economy will still grow to actually cover up that extra 4% that the central bank is holding for now. And I also want to believe that it's just temporary measures taken based on the direction of the economy. Very soon, I mean, there could be a reverse trend on that, and banks will have a lot more money. Great. But in terms of Zenith, I think we are quite comfortable.
Now, in terms of your share price, I mean, I have to ask, we talked about this earlier. Yesterday, we didn't see much change. In fact, it was down about 0.1%. Certainly, the market seems slightly indifferent about these results. What is your take on your share price going forward?
I would not say exactly that the market is indifferent about the result. In any market, especially in developing market, once you bring out your result, there's what I would call a delayed reaction towards that result, because the analysts will need to crunch the numbers. They need to put things together and actually try to see, and you also see that this half-year result, they also want to look at those numbers, do a trend analysis and see how will you land, because you are just halfway into the journey for the year. How would you land? But we also use this opportunity to really assure that bearing any unforeseen circumstances, which we cannot predict, the board believes that the trend will continue, and that at year end we should be able to actually give adequate returns to our own teaming investors. That we really appreciate them for. And we also try to let our investors know that our promise this year was return on average equity of about 15%.
Yes.
So if we are running above 21% right now, it shows that there's a whole lot of cushion. But we'll try as much as practical to make sure that we under-promise and then over-deliver at the end of the financial year.
Do you still stick to that guidance of 15%?
As I concluded, I said we under-promise to over-deliver. We'll continue to do that. And our payout ratio is always quite aggressive. We believe they will have a whole lot of take-home at the end of this financial year.
Well, thank you so much for giving us the story behind the numbers. That was Udom Emmanuel, CFO at Zenith Bank.